4 investments, 1 account. $4,699 deposited last month while we did absolutely nothing to earn it. No alarm clock, no commute, no boss. Just 4 carefully chosen positions sitting inside a single income-oriented account, quietly writing us a check every single month. And today I am showing you exactly what those 4 investments are, how much each one paid, why one of them took a hit this month, and what we are doing about it, and the complete $1 million portfolio structure that sits behind all of it. Every number, every allocation, every decision. Let us get into it. Welcome to the Dividend Desk, where we talk about building real financial independence with balance. And if you are new here, that word balance is the entire philosophy of this channel, because what we have built is not a portfolio you lock away and forget about until you are 65. It is a living, breathing financial system, one part funding our life right now, covering rent, utilities, and real everyday expenses, and the other part growing steadily in the background for our long-term future, both working at the same time. That is the model. And before we go any further, the important reminder: everything discussed here is for educational purposes only and is not financial advice. All investments carry risk, including the potential loss of your capital. Past performance does not guarantee future results. Please consult a certified financial planner before making any investment decisions. We are simply sharing our journey as openly and honestly as we can, so you can learn from it. Now let us start at the very top with the complete snapshot of everything we have invested across all of our accounts. We hold positions across 2 brokerages, Fidelity and Vanguard. On the Fidelity side, there are 3 accounts. The income-oriented covered call ETF account sitting at $351,000, and then a Roth and a traditional IRA that together total about $506,000. Those are our long-term retirement vehicles. Then over at Vanguard, we have a growth-focused brokerage account sitting at $388,000. Put it all together, and we are sitting at just over $1 million in total investable assets. And the simplest way to think about the structure is this. Everything in Vanguard and the retirement accounts in Fidelity are all pointed toward long-term growth. One single account, the covered call ETF account, is the income engine powering our life today. In terms of how that breaks down by allocation, 27% of our overall assets live in the income-oriented account. The remaining 67% is positioned purely for growth. And that split is not accidental. This is not a portfolio built around extracting the maximum possible yield from every dollar we own. It is a portfolio built with intention, one part working for us today, one part building generational wealth for the decades ahead. And understanding that distinction is honestly the foundation of everything else we are going to talk about today. Now, a little bit of context on why we built things this way, because I think the backstory matters. When we sold our rental home in Texas back in 2022 and made the move to Portugal, we lost the passive income that rental property had been generating for us, and we needed to replace it. Through research, through conversations with financial planners, and through the incredibly generous community here on YouTube, we discovered covered call ETFs and started to believe that this could be a genuine tool within our broader strategy. Not the whole strategy, a tool. There is a big difference. So the income account was built with one primary baseline goal: generate at least $3,300 per month consistently. Everything above that baseline is a bonus that either goes back into reinvestment or funds lifestyle decisions entirely on our own terms. And with the addition of BTCI as our higher risk, higher reward position, we believed we could realistically land somewhere between $4,400 and $4,800 per month across the full year. Last month we hit $4,699. So the model is working. Now let us talk about what is actually inside these accounts, starting with the growth side, because I think a lot of income-focused investors make the mistake of looking at their yield-generating positions in isolation without understanding the full picture around them. Our retirement accounts, the IRA and the Roth, are invested in a mix of S&P 500 and total U.S. stock market index funds. The IRA started as a 401k back when the journey at Dell began at age 22. It was originally sitting in a target date fund, which was fine as a starting point, but when it came time to roll it over into a self-directed IRA around 2023, moving it into broader, more efficient index funds just made more sense for where we are in the journey. The Roth holds a similar mix. Simple, diversified, boring in the best possible way. The goal for those retirement accounts is to get to over $2 million by the time we hit 59.5 and at least $3 million by 62. We keep those two numbers in front of us at all times because they are the anchors of our long-term plan. We could start withdrawing from those accounts penalty-free at 59.5, or we could wait until 62 and let them grow even further. That decision gets made when we get there. Right now, the job is simple. Leave them alone and let compounding do what compounding does. Then there is the Vanguard Growth Brokerage account. Nearly $400,000 sitting in broadly diversified index funds. And we want that account completely untouched until we are at least 50. No withdrawals, no rebalancing unless there is a very deliberate strategic reason. The set it and let it grow approach. And when you look at the overall performance across the growth accounts, the IRA, the Roth, and the brokerage, the original cost basis across those accounts was about $1 million. When you factor in what we have accessed in withdrawals, realized gains, and current unrealized gains, we are looking at about 42% overall total return. That is the power of long-term investing combined with patience and discipline. The stuff you leave alone is always the stuff that performs. On the overall asset mix, our top sector exposure right now is technology at 31.6%. Longer term, as we inch closer to retirement, the intention is to bring that down closer to 20%. But right now, while we are still very much in a growth phase, that level of tech exposure is something we are comfortable with. We also want to introduce more international fund exposure over time, and on the crypto side, we started at roughly 5% of overall mix and can see that potentially growing to 10 or even 20% as time goes on and our conviction builds. But we move thoughtfully, not reactively. Now let us get into what you actually came here for. The income account, the 4 investments, the real numbers. This account currently holds JEPQ, SPYI, QQQI, and BTCI. And before we get into the individual performance of each fund, let me give you a quick overview of what each one actually does, because understanding the mechanics matters enormously when the market gets volatile and you need to know whether to hold, buy more, or reassess. QQQI from Neos tracks the NASDAQ 100 and writes out-of-the-money call options on approximately a quarter of the fund. What that means in plain English is that if a share of QQQ is trading at $100, they might write a call option at 105 or 110 above the current price rather than at it. This approach generates income through the premiums collected on those options, while preserving more upside participation for the rest of the fund that is not being written on. It ticks the box for income and for capital growth, which is exactly what we need from a core holding. And because Neos uses index options to structure their covered calls, the distributions can qualify for favorable 1256 tax treatment, which means a meaningful portion of what you receive can be taxed at a blended rate rather than pure ordinary income. On top of that, as the fund harvests gains and losses throughout the year, some of your distributions may be classified as return of capital, which is not a bad thing. It is a tax deferment, an adjustment to your cost basis that pushes a portion of your tax liability into the future rather than hitting you today. SPYI from Neos operates the same way, but tracks the full S&P 500 index, the whole index, not a curated selection of it. That distinction matters because some fund managers self-select less volatile names within an index to create more stability in distributions, which sounds good until you realize you are missing out on the upside captured by the full index. SPYI gives us full exposure to the S&P 500 while still generating consistent monthly income and maintaining the same tax efficiency advantages that QQQI offers. GPQ is JP Morgan's NASDAQ 100 covered call fund. JP Morgan takes a different structural approach. They build their covered call strategy using equity-linked notes, which generates what is classified as bona fide ordinary income. That means it is very clean from a tax planning perspective. You know exactly what you are going to owe, and there is no ambiguity around how to handle it. The distributions from GPQ tend to be steady. The fund is institutionally managed, and JP Morgan's track record with this type of product speaks for itself. One thing to be aware of, though, is that GPQ self-selects less volatile names within the NASDAQ 100 rather than giving you full index exposure, which means, in a ripping bull market, it may not capture every dollar of upside. But for income stability, it does its job consistently. And then there is BTCI. This is our highest risk, highest reward position, and we want to be completely transparent about that. BTCI's underlying holdings are pegged to IBIT and Hold, Bitcoin ETF equivalents. When we made the decision to include BTCI in this account, it was a calculated risk taken with eyes wide open. We capped our crypto exposure at 5 to 7% of our overall portfolio mix. We understood going in that Bitcoin is volatile. We knew there would be months like this one. And the key thing to understand about BTCI specifically as a covered call fund is that unlike a naked options position, the downside risk here is not unlimited because the fund managers are writing covered calls, meaning they own the underlying assets they are writing options on. The premiums generated from those options provide a cushion against some of the downside. It does not eliminate the risk, but it is not a free fall either. Now Bitcoin recently dropped all the way down to $63,000, and BTCI felt that. The fund is currently showing about 31% negative in total return over the past year relative to its benchmark. That stings on paper. But here is the strategic response. We are not panicking. We are dollar cost averaging. When we originally bought BTCI back in July of last year, we paid $64.87 per share. That was essentially peak pricing. So every time the price drops, we are buying more at a discount and bringing our average cost per share down. Back in December, we picked up about $2,500 worth at just under $47 per share. In January, we executed 2 limit orders at $45 and $47.75. Most recently, we bought another $2,500 worth at $33.70, and we have a limit order sitting and waiting for if BTCI drops to $30. We are being active and intentional about this, not emotional. The total invested in this income account across all 4 funds is approximately $382,000. The current value as of end of January is $372,000. About negative 2% on current value. We have seen about $15,500 in realized losses, which came primarily from the portfolio restructuring we did last year when we transitioned out of our original fund holdings. But against that, we have generated $130,000 in lifetime income from this account. Netting it all out, realized profit of $115,000, which represents about 28% overall return. The account is doing what it was designed to do. For this past month specifically, the 4 funds generated $4,699 total. Based on the 12-month trailing distribution yield, we are projecting about 15.3% annual distribution yield from this account. If you look only at last month's distribution and project that forward, the number is about 14.3%. Now, those 2 figures being slightly different is completely normal and expected, and the reason we track both is to do what I call consensus planning. 12 months trailing tells you the historical average. Last month's number tells you what the current reality looks like if conditions held constant. Looking at both together gives you a more honest range to plan around. My projection for this year is that $4,600 will be the average monthly income, with the floor sitting around $4,000 to $4,100 if BTCI distributions really compress, and the ceiling somewhere in the $4,800 range if conditions improve. That is the planning range we are operating within, and here is something worth saying directly to anyone who is watching the market right now and feeling nervous. The temptation in volatile markets is to do something, to sell, to shift, to react. And sometimes that reaction is the worst possible thing you can do. What helps us stay grounded is having a long-term plan that we have actually written down. We have a 10, 15, and 20-year financial plan documented. We pay closest attention to the 10-year plan because that is the horizon where our decisions carry the most weight and where we have the most influence over outcomes. We automate investments wherever possible so emotions do not get a vote. We maintain a cash reserve, especially important living in Portugal, where we are constantly managing currency conversion between US dollars and euros, so that we never have to pull money out of the market at the wrong time. And we have made a conscious decision to stay away from the financial media outlets that are engineered to create fear, because clicks and calm do not coexist. The question we always come back to when evaluating any investment is simple. Can we stick with this in both good times and bad? If the answer is yes, it means we have done the work. We understand what we own, we understand the risk, and we have a contingency plan for when things do not go the way we expected. If the answer is no, that is information too. It means there are questions that have not been answered yet, and the responsible thing to do is go get those answers before committing more capital. The history of this income account tells a clear story. We started with Global X and JP Morgan funds back in 2023 when the covered call ETF space was still relatively small. Over time, as the market evolved and new, more structurally efficient fund managers emerged, we evaluated our options and made deliberate changes. Not because we were chasing better yield numbers, but because we wanted funds that fit our overall strategy more holistically. We transitioned through QILG and XYLG briefly before landing on our current 4-fund lineup. Every change was made with intention, documented, and evaluated against our long-term goals. That is how this should work. If you are just getting started with covered call ETFs and trying to make sense of the enormous number of options now available in the market, stockanalysis.com is a genuinely useful starting point for pulling clean data, building watch lists, and running your own comparisons. And if you want a much more organized framework to work from, the Income 360 file covers over 80 funds, categorized and structured to help you cut through the noise quickly. It includes distribution income details for all of the funds, annual planning tools, reinvestment analysis, and top 10 lists built specifically to help you understand why total return matters far more than chasing raw yield numbers. That file is linked in the description below, along with a video from last week that walks through a 2-bucket strategy framework for $1 million, $1.5 million, and $2 million portfolios, which is directly connected to everything we talked about today. The single most important takeaway from this entire conversation is one we come back to constantly here at the Dividend Desk. Do not chase yield. A 30% distribution rate on a fund that is quietly eroding in value is not a win. A sound fund with a 12 to 15% distribution rate that preserves its NAV, generates tax-efficient income, and mirrors a strong underlying index over time. That is a win. Build your income strategy around structure, tax efficiency, and total return, not just the biggest number on the screen. We will be back next month with the full update. Make sure you are subscribed so you catch it. And if today gave you even one new piece of clarity on how to think about income investing in the real world, hit the like button. It helps this channel reach more people who are trying to build something real. See you at the next one.